Well, welcome everybody to the halftime report. We're trying something different this time. Instead of doing 4 quarterly reviews, which are very similar from one to another, we're attempting to break this up a little bit. We'll do a halftime, and then we'll do a year end, and then we'll also have the 2 other quarter reports that'll look very similar to the reports we've had in the past. So let us know what you think about this format. If you like it, we'll continue. If you don't, we'll revert back to the old method. I wanted to kind of change things up a bit with some graphics, maybe make it look a little bit more entertaining. Before we begin, there are always legal notices. Our compliance department ensures us of that. So just take a moment or two and read through the important disclosures and disclaimers. If I were to put a word on this particular report, a theme, it would probably be expect the unexpected. 2015 was full of surprises, from big central bank moves and as a result, negative interest rates. We've had a lot of things happen year to date. So what we're going to do today is focus a little bit about what's happened year to date, where we are now, and hopefully a clue as to what might lie ahead. But before we get into the economic nitty-gritty, let's also reflect on some of the other big newsworthy items that occurred so far this first half of the year. One of the big news events that occurred this year was the ending of some popular television series. So as a quiz, which popular television series is signing off after a final season? Is it Parks and Recreation, Mad Men, The Late Show with David Letterman, or all of the above? As we know, the answer is, in fact, all of the above. This will be the final season for all 3 shows. This, believe it or not, got an awful lot of news time. The answer is that the arc underneath the basket will be extended to 4 feet instead of 3. There will also be a 30-second shot clock and fewer timeouts. This should help in scoring and make the game a bit more exciting. If you're an ESPN fan, this got a lot of news and a lot of time spent discussing those changes. And we can't finish the world of sports without Inflategate. In fact, there was news breaking just yesterday, and we've heard from Tom Brady, we've heard from the owner of the Patriots, we've heard from just about everybody except the coach. Frankly, there's been way too much news and time devoted to this story. So let's move on to the real news, which is our economy. So far this year, it's been rather boring. The market has really gone nowhere. As we can see from this slide, the first bar with respect to the S&P represents performance last year. The second bar, which is really barely a line at all, represents where we are year to date. This has actually been a reflection of kind of a regression toward the mean. The things that worked very well last year, not working so well this year. In fact, if you look at the last set of data, look at the huge difference between where real estate was last year. This is REITs, Real Estate Investment Trust, versus the performance this year. Also, with respect to European markets, or the global markets rather, net negative last year, net positive this year. And in fact, the performance year to date has been better than that of the U.S. The market has been a complete reversal of last year. And performance has been a little bit different and difficult as well. So far, with the exception of the NASDAQ, most major U.S. benchmarks haven't had any gain whatsoever. The Dow lost 1.14% through June 30th. The S&P was up 0.2%, and the NASDAQ was up 5.3%. I would have to say that the NASDAQ is up 5.3% on the backs of very few companies. If it wasn't for Amazon and Google and maybe Facebook, the NASDAQ wouldn't be up quite as much. The NASDAQ also represents biotechnology companies, which have been on fire this year, as have all the healthcare companies. On the home front, the economic performance of the U.S. was lackluster as well. While unemployment has improved and inflation remains below Fed targets, GDP has been fairly slow. In fact, looking at this slide and comparing the light green number at the far right to the dark green number at the far left, you'll see in both cases the first quarter last year and this year are both slightly negative. The last 3 quarters have been rather strong. In fact, coming off of the first quarter last year, we had GDP growth of 4.6%, 5%, and 2.2%, for an average of a little under 3. We expect this year to be fairly similar. GDP, which was reported yesterday, came out fairly robust, under 3%, and we expect the next quarter and the final quarter to be an improvement off these levels as well. Economic data is certainly showing signs of improvement. So why the slow growth in the first quarter? That can probably be attributable to 5 key areas. Lower oil prices is certainly impacting investment in the mining companies, oil drilling companies, transportation, and such. The strong US dollar, which gained over 20% in value against the euro, is impacting exports. And a decline in exports, which were down about 3% year over year, is impacting our GDP. US consumers, surprisingly, aren't spending as much money as what was expected, in spite of much lower oil prices. And this lower than expected spending may also reflect on the weak wage growth. Despite 5 years of economic growth, real wages, that's net of inflation, are actually about 1% or so lower than where they were in the start of 2009. So we really haven't seen a lot of wage growth. While growth in the US has been slow, growth in Europe has accelerated, and that's in spite of a lot of negative headlines. Many of the country's largest economies, including those of Spain and France, delivered relatively strong GDP growth in the first quarter of the year. As a whole, the Eurozone grew by almost 0.5% during the quarter, and this was a significant outperformance to the U.S. first quarter. We will probably see more of that to come. One of the biggest reasons for the European outperformance is the ECB, or their central bank, has initiated QE. The European Central Bank took a page from the Federal Reserve's playbook and began a round of quantitative easing. The hope was it will spur economic growth, and it seems to be effective. The Eurozone is beginning to show signs of a recovery. European stocks, the EU, has lost value against the US, which makes their exports more attractive. And the European consumers are actually spending more, and part of that is probably related to cheaper oil prices. This QE, same play, different continent, more than likely same outcome, and that bodes well for the European stock markets. The euro area was also full of surprises during the first half of 2015. Defying conventional wisdom, interest rates in some European countries dropped to below 0. European countries, companies, and entrepreneurs are getting paid to actually borrow money. And ordinary folks with money in many of the banks are getting letters from the banks saying that they would be actually charging them to hold their money. This is hugely deflationary and is keeping the specter of inflation well controlled. In fact, the New York Times reported recently that a woman, Eva Christensen, she's an entrepreneur from Denmark, got a call from her bank about a business loan that she had applied for. And as a result, the negative rates means that depositors are paying the bank to hold money. In her case, the loan was negative, but with loan origination fees and whatnot, she would spend money, but it is absolutely cheap money. These negative interest rates encourage banks to lend and make savings less attractive. When people lose more money each year to inflation than they gain from interest, savings becomes a losing proposition. Consequently, investment and consumption should increase and stimulate economic growth. And that's exactly what we've seen. Europeans are spending more and spending more per capita than we as Americans are. And as a result, their economy is starting to show signs of improvement. This ECB stimulus and negative interest rates also spurred economic growth throughout Europe, which has helped make European stock markets more attractive to investors as well. The CAC 40 was up 12.1% through the first half of the year. The German DAX was up 11.6%. The only one that suffered a bit was the UK, which was down 0.68. These all are relatively better growth, mainland Europe, than what we're seeing here in the US. And the ECB isn't the only central bank pursuing quantitative easing. The Bank of Japan is doing it all over again. The Bank of Japan, to a large degree, kind of invented quantitative easing way back in 2000. It tried it back then and applied it liberally since in an effort to encourage growth. Its economy has been in a huge slump, though, and it owes it primarily to this deflationary pressure that we talked about before, an aging population and a declining workforce. This time around, the intent of QE is to push inflation higher. The bank would like to see inflation up to 2%. And this hopefully will spur economic activity. To date, it's been kind of foiled by lower oil prices, which is actually pushing inflation closer to zero. The value of the yen has dropped with QE, giving a huge boost to Japanese exports. And as a result, this has lent itself to higher corporate profits. As a result, the Japanese stock market has done phenomenally well. While QE hasn't had a great impact on their desired economic effect, it has helped quite a bit, as I said before, with respect to the market. Corporate profits are at record levels. Exports have been down a bit, but when translated into a cheap yen, they're very profitable and significantly large. And this has helped not only the stock market in Japan, but in the surrounding area. The Hong Kong benchmark Hang Seng was up over 11%. The Japanese Nikkei was up almost 16%. And the Chinese market, in spite of some weakness here recently, was up 32% at the end of the quarter. It was up as much as 55% earlier in the year. This certainly has helped their stock markets on a regional basis. While China has shown much better growth than the U.S., there has been a significant amount of weakness here lately. I would worry a bit about China. China does look like a little bit of a bubble, both in terms of their market as well as the real estate market, some of which can be related to very lenient lending practices. The requirements for margin, the requirements for real estate have been very low, allowing people and causing people to want to speculate. And some of that air is coming out. And that's why you've seen some fairly violent short-term corrections with the Chinese. Looking at the Chinese stock market a bit more closely, you'll see that from the beginning of the year through June 12th, the Chinese markets increased nearly 59%. And while we've had a pretty abrupt sell-off the last couple of weeks in June, and certainly here in July, the markets are still up significantly since the beginning of the year. We would expect the Chinese economy to continue to grow and grow at a faster pace than the U.S., and that'll also help with the other Asian countries. One of the firms that we receive research from, Mercer and Associates, is expecting that the emerging markets the next 5 years will have compounded returns of nearly 10% a year, while domestic U.S. more like 3% a year. That has a lot to do with economic growth and activity and also present valuations. Another issue that we have to contend with is the volatility in government bonds. Even though the Federal Reserve has not raised rates yet, the bond market, which is predominantly an auction-based market, is beginning to take action. Government bonds have been remarkably volatile. For decades, they've been thought of as safe havens during tumultuous periods of time. the last 30 plus years, interest rates have been falling. So not only have we gotten the safety of government bonds, but price appreciation as well. Today, not so much. The average government bond fund was down better than 1% year to date, and we think we're going to see a bit more of that. So why are the markets so volatile today when we haven't yet seen the Federal Reserve take action? A few weeks back, Barron's suggested two possible reasons. The first is high-frequency trading driven by computer algorithms. A lot of folks speculate in the bond market. The bond market on a global basis is significantly larger than the stock market. And because it's not a centralized market and it's a group of auctioneers, if you will, it is also a little bit less liquid. And the liquidity issue has a second impact on pricing. If everybody decides to get in or out at a given time, it'll be difficult and there will be price imbalances. And we're beginning to see a little bit of that today. As a result, in our portfolios, we've made the fixed income component look a whole lot less like government bonds, a whole lot less like the U.S. bond aggregate index. And the hope is it will be much less volatile than the broad-based bond market. But this is an issue that we're going to need to contend with. This could be a decade-long issue, as we've had and have enjoyed 3 decades of a very positive bond market. As interest rates do start to creep back up, there will be much dislocation. The problem, though, is as most of our clients are either pre or post retirees, we don't want to take or accept the risk of having an all equity portfolio. So we need to count on bonds as a shock absorber to the stock market. But if that shock absorber doesn't contribute to performance, it becomes somewhat problematic. And we're certainly looking at alternatives, as I said, adjusting what we own with respect to bonds, and also looking at alternative investments as a means of filling the bond gap without exposing ourselves to unnecessary interest rate risk. When you look at the world, economies in general are looking better. And we hope an improved economy drives corporate revenues, which ultimately improve stock pricing. Everybody is showing some degree of improvement. The exception might be Russia, and they have their own unique set of problems. But generally, inflation is less problematic in the broad-based countries. Some of the BRIC nations, Brazil in particular, is seeing a little bit of higher inflation. And as a result, they're seeing a little bit higher unemployment. But Euroland is looking very strong. Their inflation is very low, as I said, nearly deflationary. Unemployment, while it's high, has been coming down. And this is very similar to the U.S. market. Remember when we started quantitative easing, unemployment was very high. And while we had quantitative easing for nearly 5 years, our economy grew very slowly. Unemployment came down also very slowly, but the stock market took off. And from trough to peak, up nearly 175 or so percent. We could see something similar, maybe not to the same magnitude, with respect to Europe going forward. A discussion of Europe would not be complete without some comment on Greece. Obviously, there were significant uncertainties as of the end of the quarter, the end of the first half. Many of these uncertainties have been, to a large degree, resolved. We think the can, to a large degree, has been kicked further down the road. We think the problems with Greece continue to linger, but the Greek problem in and of itself is somewhat a non-event. If we looked at all of the Greek debt outstanding and assumed it all went to zero as a percentage of global debt, it's de minimis. It's a rounding error. In fact, daily price fluctuation of global debt alone surpasses the total amount of Greek debt outstanding. So while it's newsworthy, while it may have some implication as to, or other countries within the EU attempt to do something similar, the expectation is Greece will stay within the EU. It's less problematic for their people. The problem will continue, but it won't be disruptive from the standpoint of either our economy or, for that matter, the global economy. Clearly, the $64,000 question is, when do we see a rate hike? Much expected, long awaited, much talked about. I know I've been talking about it for a better part of 2 years. We think it's a lot closer now than before. But just to give you an idea of how this changes, and changes very quickly, as recently as June 17th, Janet Yellen made some comments, and by the way, this was at the height of the Greek problem, that perhaps some weakness in Europe may cause the Federal Reserve to delay raising rates here. Now that the Greek problem is resolved and our economic activity looks to be improving, the idea of a rate hike as recently as September is back on the table. Folks who believe that the Fed may not raise rates in September are certainly looking at the next hike to be in December. So if we do see a rate hike, it could very well happen before the end of this year. You know, if you think about it, the Fed is really right where it wants to be. The Fed was expecting to raise rates when the unemployment rate in the U.S. was 6.5% and inflation was about 2%. That was the target metrics that they were looking at. Today, unemployment is below 6%. And the inflation rate is expected to be near 2% in 2016, and that would be the early part of 2016. So we're much, much closer to having the Fed raise rates. One of the reasons that's been bandied about as an excuse for not raising rates may very well be this discussion of the wealth gap. A recent paper by the Organization of Economic Cooperation and Development, the OECD, reviewed 20 of the world's largest developed countries and reported that the wealth gap is as wide today as it's been in the last 30 years. In fact, the top 10% of the wealthiest households hold half of all wealth, while the next 50% hold almost all the rest. The bottom 40% represents just 3% of all wealth. As a result, many communities are beginning to make changes that will affect the income levels for people who earn minimum wage. Los Angeles City Council recently voted to raise the city's minimum wage from $9 to $15 an hour. The increase will be implemented gradually between now and 2020. So the real question is, with all this discussion, does the minimum wage really need to increase by 2/3? According to MIT and the researchers there, an individual living in Los Angeles or Long Beach, Santa Barbara, or Santa Ana area, who's a sole provider for his family and earning a full-time wage, would need almost $60,000 a year to earn a living wage, and $9 an hour puts them at a poverty level. So a move to $15, while politically it sounds necessary, doesn't really fix the problem. The problem will only be fixed with better fiscal policy and a revision of the tax code to help stimulate economic activity, new job creation, better education, and so forth. Throwing money at the problem doesn't necessarily help. Another issue that's impacting the economy presently is this low oil price. A low oil price is much the same as a tax cut, and it should help stimulate consumer spending and improve consumer confidence. Although we haven't seen a lot of consumer spending as of yet, it certainly is a plus to the current and forward-looking economies. So what exactly do things look like going forward? Because there are so many moving parts out there, one can make an argument for better times as well as worse times, for improving stock markets as well as decreasing stock markets. Larry Summer, who's the former Secretary of the U.S. Treasury, well-known economist, is suggesting that we're right in the middle of what he refers to as secular stagnation. And secular stagnation is reflected or is identified as low or no growth. We've seen stagnant growth, but growth nonetheless. Weak inflation. We certainly have seen that both here as well as Europe. Low interest rates, and also where savings exceeds investment. And when I talk about investment, I'm talking about essentially infrastructure investment, investment in education and roads, and things that can spur further future economic growth. As a point of reference, European consumers are spending, and they are spending all of their low oil price windfall. There's not a lot of savings, at least there. So Summers thinks we're seeing stagnation. Contrary, Ben Bernanke says Larry Summers is completely wrong. And actually, the situation we're in today can be blamed on a combination of both cyclical and special factors, and it is not a secular stagnation market. Given the choice of the two arguments, I tend to, more so than not, agree with Ben Bernanke. I don't think we're seeing global stagnation. I think certainly the unprecedented amount of QE has really caused inflation and to some degree interest rates to be as low as they are. Once we start to remove that from the system, things will over time normalize. So it's less of an issue today. One interesting point is the international monetary policy really likes what the future looks like, at least in the short term. Recently, The Economist reported that for the first time since 2007, the IMF expects every advanced economy to expand. Growth in developed countries should exceed 2%, and that would be for the first time since 2010. So since we look at things from a macroeconomic point of view, this is really pretty positive and should lend itself to better stock valuations this year and perhaps next year as well. Remember, next year is an election year, and that's generally pretty positive. But if we look at current valuations and we look at the fact that interest rates will start to rise, many people agree that the growth we see going forward may in fact be a bit slower than what we've had in the past. Just a while ago, I referenced some economic data that we received from Mercer Analytics, and they're suggesting that the U.S. market will grow at about 3% a year. I'm referring to large cap U.S. blue chip, whereas growth could be better elsewhere, emerging markets, Europe. Bonds, which have enjoyed a 7+% annualized return over the last 30 years, will probably see returns in the 2 to 3% range. So things will be different. We can't get to where we want to get by doing what we've done in the past. There's going to need to be some adjustments and modifications along the way. As far as where we are in terms of this bull market, there's a lot of debate there as well. Ken Fisher, who's a well-known and renowned portfolio manager, says the markets climb a wall of worry, and as long as people are still talking about the headlines and worried about this event or that event, the market is nowhere near being complete. Actually, the time to worry is when there isn't a lot of worry out there and everybody tends to be a bit euphoric. We saw that in the big bull market or the end of the bull market with the dot-coms. Everybody was euphoric. Matrix and matrices were all rearranged and redefined. Valuations were ridiculously high. And just as positive as Ken Fisher is, Bill Gross, renowned bond manager, is a bit more dour. He suggests that we're in a a period of low growth, and our 35-year investment supercycle may in fact be exhausted. To some degree, his comments are specific to bonds, and we know why. As interest rates will start to rise, that doesn't bode well for bonds. But the bull market may require a shift if we want it to continue in terms of the types of countries that we invest in. It may not be so much U.S.-centric. We may need to look for returns in the internationals and emerging markets and be a bit more nimble in terms of certain sectors, as an example, healthcare or maybe financial services. There's been a lot of concern over what happens when the Federal Reserve starts to raise rates. And while I'm sure that the first rate hike will have a very short-term negative impact on the overall market because it will punctuate the beginning of a change, when you look at the data, it suggests that with every shift in interest rates, this chart suggests different periods of time when the Federal Reserve started to raise rates or the end of a long-term decrease in rates stopped, followed by an increase, that in the very short term there was a disruption in the stock market, but then 3 months and 6 months and a year out, valuations were significantly improved. And I would expect the same thing. Our informal research suggests 12 months out, the S&P on average is up about 10% when we include every single shift like this going back to 1900s. So that's encouraging. Forecasting isn't easy. So all of the comments that we made here about who says what and when and why, take with a bit of a grain of salt. Historically, over time, only 46% of the prognostications are accurate, leaving 54% to be erroneous. That's worse than a random flip of a coin. So please keep that in mind. We know that there will always be some opportunities. We're looking at a few. We think if interest rates rise, banks and financial companies should do reasonably well. Local and regional banks who are involved in mortgage lending should improve. Their margins should explode. So that's a positive. Healthcare should continue to perform as well over a period of time. And we like the international markets presently and for the time being. So as shifts and adjustments get made, those are areas that we certainly expect to outperform the broad-based U.S. market. Areas that we're a bit concerned about, one in particular would certainly be U.S. valuations and the bond market, and for that matter, anything that looks like bonds. High dividend yielding stocks, while there are many reasons to own them, and they're a sound long-term investment, we'll probably see some undue pressure in the short term as their dividend will be compared to interest and will look much more like a bond than a stock. So with that, thanks for listening. My team and I are here to help to answer any questions you have. If there's anything that we can do for you in the near future, please don't hesitate to call. And we will have another one of these shortly after the end of the third quarter. This format will, or I should say that format will look more like the format of old, many more economic slides. I'd like to have you look at a couple of slides that describe some of the indices that we looked at, again provided by our friends in legal and compliance. One slide talks about the domestic indices, and the other slide will talk about some of the international indices that were either used or described in this presentation. Once again, thank you very much for listening. This has been the Halftime Report, and please, if you have any questions at all, let us know. Also, let us know if you enjoyed this type of a presentation, whether this was more helpful to you than the prior format, and we'll certainly adjust or modify. Hey, one other thing I want to mention is you'll be getting in the mail here shortly an invitation to download our phone app. We've spent a lot of time developing an application that will allow us to push this type of content out to you on a regular basis, and it'll be as close to you as your telephone. So once again, take care, have a wonderful balance of the summer, and we'll talk to you very soon. Thank you.